Hello and welcome to our discussion on the consolidated balance sheet. We'll continue our discussion by taking another example. So this is the balance sheet of two companies, A and B, with certain assets and liabilities. And the question goes on like this. A acquires 90% stake in B at the market price, and your market price means the market price of the shares, and the purchase consideration is being discharged by the issue of shares to the extent of 50% and the balance to the issue of bonds. In this case, unlike the previous ones, the market value of some of the assets of B are given along with the price of shares on the date of the acquisition. Now let us go to the Excel. So this is the information given, and A and B. A acquires 90%, so the minority interest, uncontrolled interest, is 10%. The price of A share is 45 and price of B share is 60. And the purchase consideration is calculated on the basis of the number of shares. So the number of shares of B is 3000. A acquires 90% of that. The market price of the shares of B is 60. Of B is 60. So therefore the purchase consideration is 60 into the number of shares, that is 162,000. And this purchase consideration is discharged through the issue of shares to the extent of 50%, and the balance is issued by the bonds. The market price of the shares which are issued by A is at 45. So the number of shares that you are issuing is 1800. The capital is always shown at 5, and the balance is the share premium, which is 40. So this is the way the purchase consideration is discharged. To find out goodwill, we have to deduct the purchase consideration, use purchase consideration, and from there deduct the proportionate equity. And to find proportionate equity, let us find the equity of B. The equity of B consists of, if the market value of the assets are given, then R&D, plant, R&D, plant. So let me do that once again. Inventory plus debtors plus R&D plus plant plus cash minus the liabilities, and the liability is 10,000 plus 11,000, so equity is 50,500, and of this A share is 45,000 and the minority share is 5,050. So therefore now we can calculate the goodwill. Goodwill is equal to purchase consideration minus the proportionate equity. So we have the goodwill, purchase consideration, discharge of purchase consideration, and the minority interest. With this information we can calculate or prepare the standalone and consolidated. First let us prepare the standalone. The creditors of A will continue to appear as it is. The debt of A will appear to continue as it is. The capital will be the capital of A plus the new capital issued. Reserves, no change. The share premium 72,000, and you are also issuing bonds of 80,000. So as a result you will have the total of sources. The total of sources is 274,000. No change in the cash, no change in the inventory. These are all standalone balance sheet of A. No change in the debtor, no change in the R&D, no change in the plant, and B share will appear at the purchase consideration money that you paid. In other words, the price that the company A pays to acquire the shares of B, and that will appear as an investment. So that is the that is the standalone balance sheet of A. The standalone balance sheet of A will show the new acquisition, that is the B shares, and will show the corresponding payment to acquire the corresponding payment to acquire those shares, and the corresponding payment that you made here is through the issue of shares and the issue of bonds. Okay. Now let us see the consolidated balance sheet. In consolidated balance sheet, the investment will not appear, and the assets and liabilities of B are added to the assets and liabilities of A at the market value. So the creditors in the consolidated balance sheet will be the sum of the creditors of both the companies. The capital is only of A, the reserves will only of A, premium only of A, bonds only of A, but another term will come into picture, that is the minority interest. And the summation of the total sources of A consolidated is given here. Similarly, the assets of A will be added to the assets of B, and that too at the market value. So we'll take the new value of the assets, 30,000 plus 5,500, 15,200 plus 20,000, 7,000 plus 25,000, and this share will not appear, but another new item called goodwill will appear on the balance sheet of the consolidated consolidated balance sheet, and the total of will be 300,000. That shows the assets are equal to the liabilities, but plus equity. So let us recap. In a standalone balance sheet, B's share will appear, and the corresponding increase in the capital and the bonds will appear, because that is the discharge of purchase consideration. The discharge of, so the B share will appear, and B share is 162,000. Okay, 162,000, and the corresponding capital, the corresponding share premium, and the bonds will appear. That is, the purchase consideration and the corresponding discharge is shown on the standalone balance sheet. Whereas in case of a consolidated balance sheet, you don't show the investment, but instead of the investment, the assets of A and B are added at the fair value. Okay, at the fair value, you can see that the assets of A and B are added at the fair value, and any increase or decrease due to the excess payment will be shown as the goodwill. So that is the consolidated balance sheet. So to recap, in a standalone balance sheet you see the investment, but in a consolidated balance sheet one will not see the investment, but is adjusted by the assets and liabilities, and any excess or excess will be shown as the goodwill. Thank you.